This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss ongoing market volatility and continuing tariff concerns. For some investors, it may feel as if the market is stuck in Groundhog Day, as I have discussed tariffs and volatility in a number of past videos. The stock market is nearing correction territory again, and tech stocks are leading the decline. It's important to remember, though, that market cycles naturally include both booms and busts. Despite current uncertainty, historical patterns suggest this correction could stabilize and reverse once there is greater clarity on trade policies. However, those who have followed me for some time know that one of our core philosophies is built on not attempting to predict the future, but to prepare for the future regardless of what may happen. First, this chart shows stock market corrections since World War II. It shows that pullbacks of 10% or more are not uncommon, and that recoveries tend to occur swiftly, taking just 4 months on average. Stock market corrections have averaged 14.3% and often rebound when least expected, as demonstrated during the pandemic, tech bear market, and banking crisis. The S&P 500 is once again approaching correction territory, and the NASDAQ has been in correction for almost a month due to market volatility over the past few weeks. It's often said that markets take the stairs up, but the elevator down. What this means is that market recoveries typically happen gradually, while declines can happen suddenly. Even though this is the case, markets also tend to make gains over longer periods of time. This is relevant today because even though the S&P 500 is in correction territory, the market has only retreated to levels that were reached as recently as September 2024. So it's important to maintain perspective on long-term growth. Next, it's important to remember that making investment decisions based purely on emotions often leads to poor outcomes. However, we do believe that following tactical or active approaches implemented professionally with logic and discipline can help provide stability. This chart illustrates the value of an initial $1,000 investment in the S&P 500 under different scenarios over the past 25 years. You've probably seen charts like this before, often with the tagline, "It's time in the market, not timing the market that counts." While we do agree that long-term investing is critical, we also believe tactical and active management can add value. As shown in this chart, a simple buy and hold strategy would have grown to $4,136 over 25 years. The green bars highlight the impact of missing only the worst days, while the light blue bars show the result of missing only the best days. The goal of tactical portfolio management is not to perfectly time the market by avoiding the worst days while capturing the best. Let's be honest. We'd all love to sell at the top and buy at the bottom, but that's not realistic. Instead, the dark blue bar demonstrates the potential benefit of missing both the best and worst days, which can often occur close together. Over the 25 years, this approach would have resulted in a higher balance at $4,621, while also delivering a smoother return experience and ultimately reducing volatility, which is a key to long-term investment success. Finally, tech stocks have gone through a difficult period, with tariff uncertainty contributing significantly to market volatility. The so-called Magnificent Seven stocks have fallen 20% from the December peak as valuations adjust to potential earnings deceleration. While the tech sector has struggled, 8 of the 11 S&P 500 sectors remain positive over the past year. International stocks have performed well this year, along with a number of different alternative strategies. Again, all of this highlights the importance of a truly diversified portfolio, or what we call a multi-dimensional approach towards portfolio management. I hope you found these high-level insights helpful. If you are a financial advisor, and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. You can also click on the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you're an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.